Hi class, pleasant day to all of you. This is your Professor Dan. And in this lecture video, we are going to discuss the continuation of incremental analysis, which is the last video on this topic. And here, we are going to analyze the relevant cost and profit on the following: sell or process further, next, retain or replace equipment, and eliminate an unprofitable segment or product. Okay, let us now start the discussion. Sell or process further. Here, in this incremental analysis, we will analyze the revenue, cost, and profit. Okay, so let us have an illustration. Woodmasters makes tables. It sells undecorated tables for 5,000 per unit. This is per unit. The cost to manufacture an undecorated table per unit is 3,500, and the breakdown of this 3,500 is as follows. Okay, we have direct materials of 1,500, direct labor of 1,000, variable overhead of 600, and fixed overhead at 400 for a total of 3,500 per unit. Okay, these are the given cost. Here we have additional information. Woodmasters currently has unused productive capacity that is expected to continue indefinitely. Some of this capacity could be used to decorate the tables and sell them at 6,000 per unit. Class, take note that they are selling tables which is not decorated at 5,000 per unit. If they will process the tables and decorate it, then they can sell it at 6,000 per unit. For a decorated table, direct materials and direct labor will increase by 200 and 400 per unit respectively. So if they will process it, there will be an increase in direct materials and direct labor at 200 and 500 and 400 respectively. Okay? Variable overhead cost will increase by 240. No increase is anticipated in fixed overhead. Okay. So here, if we will sell undecorated, okay, this will be the cost, the 3,500. Our sales would be 5,000, and that will be our sales per unit, 5,000. Okay? So here, this is our cost of goods sold. Okay. So just to do a proper presentation, so this 3,500 will be deducted from sales. So let's just put it here, okay? So here you have a gross profit of 1,500. That is for undecorated. So we have an option to decorate it and then sell the decorated table, okay? So we will process it and then sell it after it is already decorated. Okay. Based on the information, we have 6,000 per unit. That will be the sales for decorated tables, 6,000 per unit. And here we have the information as for decorated table, direct materials and direct labor will increase by 200 and 400 per unit. So this means that direct materials will increase by 200, so it will become 1,700. Okay? And direct labor will increase by 400, so it will become 1,400. Okay? Variable overhead costs will increase by 240. So this 600 will become 840 because it is increased by 240. And then here, no increase is anticipated in fixed overhead. So there's no increase on fixed overhead. Okay, so the total of this will be 4,340, and sales minus cost of goods sold of 4,340, we will have a gross profit of 1,660. Okay, as you can see, processing the table to be decorated will provide a higher gross profit. Okay? So the difference of that is about 160. So when we are going to make an incremental analysis between process and cell, so we will start with process, then minus whatever the cell data is. So 6,000 minus 5,000, we have positive of 1,000. That's the increase in sales, okay? And for the cost, there is also an increase in cost. 4,340 minus 3,500, that will be 840. So we are generating revenue of 1,000 and cost is 840 based on our discussion for sell or process. As long as the revenue is higher than cost, then we have to process further. So in this case, the rule is in this situation is applied on this situation. The revenue is higher than cost and the difference is 160. So in this case, our decision is process to decorated table. Okay? Let us move on now. Our next situation is whether we have to repair, retain, or replace equipment. On this example, we are going to uh, have alternative for retaining the equipment and replacing the equipment with a new one. Okay. So here we are going to perform the incremental analysis of comparing the cost to retain it or replace it with a new one, okay? So this is our problem. Jeff Coat Company has a factory machine that originally cost 1,100,000. It has a balance in accumulated depreciation of 700,000 at 400,000 book value. The fair market value of the machine is 250,000. It has a remaining useful life of 4 years. The company is considering replacing this machine with a new machine. A new machine uh, is available that costs 1,200,000. It is expected to have 60,000 salvage value at the end of its 10-year useful life. If the new machine is acquired, the variable manufacturing costs are expected to decrease from 1,600,000 to 1,250,000 annually, and the old unit could be sold for 50,000. Okay, class. Let us recapitulate the given data. And we are required here to prepare incremental analysis whether to retain or replace the equipment with a new one. Okay. So what we're given are on the old machine, the cost here for the old machine is 1,100,000. It has a balance in accumulated depreciation of 700,000. Okay, we are trying to summarize what we're given of 700,000 and a book value of 400,000. The fair market value of the machine is 250,000, meaning that if we are going to sell this old machine, there is someone in the market that is willing to buy it at 250,000. Okay? A new machine is available that costs 1,200,000. Oh, by the way, here we have forgotten that it has a remaining useful life of 4 years. This is very important. So, useful life of 4 years. Okay? The company is considering replacing this machine with the new machine. So, the new machine, and there is an available new machine that costs 1,200,000. Okay. It is expected to have 60,000 salvage value. So the salvage value of the new machine is 60,000. Salvage value is the value that remains after the useful life. Okay? So the useful life here is 10 years for the new machine. So the useful life is 10 years. So it means that after 10 years, you can sell whatever the condition of the machine at 60,000. Okay. If the new machine is acquired, variable manufacturing costs are expected to decrease from 1,600,000 to 1,250,000. So it means that under the old machine, the variable cost per year is 1,600,000. Okay, so under the new machine, the variable cost will be 1,250,000. And the old unit could be sold for 50,000. So the salvage value of this old machine is 50,000. Okay, so we all have the information in this. Okay, the first thing that we have to do, class, okay, in the incremental analysis is that let us see how many years that we have to evaluate the two situations. Okay, the old machine has only 4 years remaining life. So this is the period that we have to evaluate the two machines. So we have to evaluate it for in 4 years, within 4 years. Okay. So class, let us take a look of the information that we have. As we have learned, the cost is already a history, so this is already a sunk cost. So it's not relevant in our analysis, as well as the accumulated depreciation and the book value, because we cannot do anything on this anymore. Okay. However, though these are sunk costs, in particular the book value, the fair market value of the machine is a relevant data. Okay. So class, what is, if we are looking at the old machine, the significant data here is the variable cost per year. In the old machine, the variable cost is 1,600,000 annually. So for 4 years, the variable cost, 1,600,000 times 4 years, is 6,400,000. So it means that under the old machine, Jeffcoat Company, the variable cost is 6.4 million for 4 years. Okay. At the end of fourth year, this salvage value means that it will be when the machine, after 4 years, the machine can be sold at 50,000. So after 4 years, the company will receive 50,000. So it means a reduction from the cost, because this is the money or the cash that will be received in selling the machine. Okay, so in effect, under the old machine, the net cost is 6,350,000. Okay. Now for the new machine, the information that we have here is that the cost of the new machine. So if we are going to buy, we are not going to use the old machine, we will buy the new machine. It will cost us 1,200,000. So the cost of new machine is 1,200,000. Okay. Okay, 60,000, this is the salvage value after 10 years. So this 60,000 is not relevant in the period that we are looking at, which is 4 years. Okay. So another relevant and most important data is the 1,250,000. Okay? This 1,250,000 is the variable cost per year. So here, 1,250,000 times 4, then under the new machine, the variable cost will be 5 million. Okay. Plus, take note that if we are going to buy the new machine, it means that we can already sell the old machine. So if we have sold it, okay, we will generate 250,000 income. And that income is what you can call an opportunity income. Okay, we will be able to have the opportunity to sell it. Okay, so here in this case, and if we are going to buy the new machine, We don't need the old machine anymore, so we can sell it. And by selling it, we will generate opportunity income of 250,000. Okay. So class, that is the importance of the fair market value, okay? Even though that the book value is a sunk cost, however, its fair market value is very relevant data in the incremental analysis. So in this case, the cost net is 5,950,000, doing the mathematical calculations on all of these amounts. Okay. So here, obviously, there is a difference of 400,000. And this difference is showing that the new machine has a lower cost in the amount of 400,000 in comparison with the cost of the old machine, the operating cost of the old machine. So here, if we are making a detailed comparison or incremental analysis between new machine and old machine, so we will have 5 million minus 6.4 million, you will have a positive 1.4 million. And then 250,000 minus 50,000, you have 200,000. So here, negative 1,200,000, then there's nothing. So you have a negative here of 1,200,000, and the net effect of this is 400,000. Okay, so our decision is replace the equipment, replace the old the machine. Okay. Okay, class. So with this, let us move on. And here we have eliminate an unprofitable segment or product. And this supposedly we are to analyze the revenue, cost, and profit between their segments or products. Okay. And class, in most cases, management considers the qualitative effects of eliminating unprofitable segment. That is, if we are going to eliminate a segment or product, we have to make sure that we are going to consider the qualitative factors, which are, examples are effect on other product lines, the effect on customers, the market, company's image, employees, and community. Okay? The qualitative effects is weighed against a quantitative performance of the unprofitable segment or product line. Thus, it is very complex and challenging to make the right decision. Class, we will not do illustration or quantitative analysis on this elimination of an unprofitable segment or product because of its complexity. Okay? So, class, that's it. And if you have questions, please let me know. Stay safe and have a great day. Bye for now.